Today's mortgage interest rate is sitting at 6.81%. That means that if you buy a house today for $400,000 with a down payment of 20% and a 30-year mortgage, you will end up paying a total of $431,785.34 in interest alone. That means that the total cost of your $400,000 house at the end of the 30 years is sitting at $831,785.34. With such crazy numbers, a lot of people have been wondering, what will be better? Should I make extra payments towards my mortgage and hopefully save on interest and pay it off faster? Or should I use the money that I would normally use for the extra payment and invest them in the stock market instead? If you're trying to figure out what's the right thing to do here, you came to the right channel, because today we're going to run a couple of scenarios that's going to help you make an informed decision and hopefully the best decision for you. Welcome to Nova Rice, your channel for financial education. In here, we talk about investments in real estate, investments in the stock market, in precious metals, and small businesses. Now, before we continue, let's learn the concept of amortization. So mortgages follow an amortization schedule. For those who don't know, amortization is basically the spreading of all the interest payments throughout the life of the mortgage. That's the simplest way to explain it. So let's suppose you have a mortgage of 30 years. So you have 0 as your starting point and then 30 as the end of your mortgage, and halfway through is 15 years, right? Now, if you pay attention to the first half of your mortgage, each time you make a mortgage payment, a big chunk of your money is going to go towards interest payment. And very little of that money, it's going to go towards the principal reduction. Now, if you were sitting on the other half of the mortgage, meaning from 15 years on, that means that each mortgage payment that you make, the majority of that money is going to go towards the debt reduction. That is the principal reduction. And then a smaller percentage of that money is going to go towards your interest payments. So the majority of financial experts suggest that if what you're looking for is pay off your mortgage as fast as possible, paying the least amount of interest possible, the best time to do it is during the first half of the mortgage. And that if you happen to be sitting on the second half of your mortgage, you're better off investing your money elsewhere, because at that point, the majority of your money, it's going towards the principal reduction anyways. But I like to think that if you're tuning into this channel, it's because you're looking to verify that information with numbers so that you can make an informed decision yourself and not just simply blindly following what some experts are saying. So to test that, let's just do a quick exercise. Let's suppose that you have an additional $100 to pay towards your mortgage every month for the first 12 months of your mortgage. So to see what paying an extra $100 every month will do to your mortgage, let's run through this exercise. So we have your loan at $320,000 because you made a down payment of 20% towards a $400 purchase. Then your interest rate, according to what we mentioned at the beginning, is 6.81%. And you have a 30-year mortgage, which that means 360 payments, right? So that means that your monthly payment just on principal and interest alone is sitting at $2,088.29. That's excluding escrow, which is anything that has to do with property taxes and insurance. We're only focusing on the debt part, which is the principal that you owe the bank and interest rate, right? So if you were to add $100 extra towards your mortgage on the first month, that means that you are actually saving $662.60. And then if you add an additional $100 on the second month, now you're saving a total of $1,320.90. And if you pay an extra $100 towards your mortgage consistently for the next 12 months, you will be saving a total of $7,591.08 for that year. So we have 12 extra payments of $100 each. That means in 1 year, you're going to save $7,591.08 in your mortgage. If you were to take the same $100 every month and invest it in the stock market, you will have a total of $1,200 invested in a year. And the average return in the stock market averages 9.83%. That means that if you invest $1,200 in the stock market for a year, your portfolio will be sitting at $1,317.96. That's a return of $117.96. Now, when you compare these two numbers, it is very easy to say, hey, why would I invest money in the stock market when I can save over $7,500 in interest in my mortgage? That's a no-brainer. But the truth is not that simple. This comparison that we just saw is not really comparing apples and oranges because it's very difficult to compare the performance of an asset that you're buying using a mortgage because that real estate purchase is much larger than the investment that you're doing in the stock market. So I have gone through this over and over again trying to find the best way to do the comparison between both. And it's very difficult unless you have all $400,000 to invest in the stock market and do a side-by-side comparison. This comparison is not fair. Why? Because you're investing a much smaller amount in the stock market and you're comparing it against a much larger debt. So unfortunately, at least in my case, I haven't figured out a way to compare these two side by side in a way that is fair. However, that doesn't mean that all is lost. There is another way to look at this scenario that's going to probably change your mind and help you make an informed decision. Let's take a look at this example. According to my research, real estate has appreciated an average of 5% annually. Yes, there are times in where the market goes up faster than others, and then eventually there's going to be a correction where prices go down or just simply stop growing. But if you take an average across the board using historical data, you will find that the average appreciation of a property sits at 5% annually. That means that if you bought a property today at $400,000 with an appreciation of 5% annually, at the end of 30 years, your property will have a market value of $1,728,776. When you compare this market value against what you pay over 30 years, that is $831,785.34, that means you're actually getting a bargain. You're paying this much to get a house that is worth this much at the end of 30 years. That will give you a total savings of $896,990.07. What do you think about that point of view? I'm pretty sure I challenge your way of thinking. Let me know what you think down in the comment section below. Now, the question that everyone has been asking for, should you really use the extra money to pay towards the mortgage and pay it off faster, or should you use that extra cash and invest it in the stock market? The answer will depend greatly on you because you and I are not the same people. But since you're here, you probably want to know my opinion. And what I will do is I will just simply continue to make the regular monthly payments to my mortgage and take that additional cash and invest it in the stock market itself. Why? Because I like to have cushions. I don't like to just have no savings whatsoever because circumstances might happen. I could lose my job. I could have a bad year financially. And I want to make sure that I can still access some cash to be able to continue paying my mortgage. Knowing the numbers that I just shared, to me, it makes no sense to rush to pay off the mortgage because I'm getting savings anyways. So I'd rather take that money and build up another asset that's going to grow over time and give me additional access to cash. However, I know that what I just shared is not everyone's cup of tea, that it's going to compensate for the peace of mind that you get when you pay off your mortgage completely. And that's completely fine. There is no monetary value that's going to compensate for your peace of mind. In my case, I get peace of mind by having extra cushion and slowly paying off my mortgage because I already know I'm already getting a bargain, because I took action today. But for some, it might not be the case, and that's okay. So if you're still fixated in paying off your mortgage faster and you want to access the calculator and figure out how much more you can add on a monthly basis to pay off your mortgage faster, I want to invite you to check out this video on the screen that's going to give you a walkthrough on how to use a calculator and share tips and how you can pay off that mortgage faster. See you in the next video. Bye-bye.